Hey guys, Mike here. So today we're going to talk about something, we just really hadn't had to talk about or even worry about the last few years. And it's what is the fuel for these tech and growth stocks to actually, be able to achieve the multiples and achieve the growth rates they've been able to achieve. And that's debt, right? All that debt they take on to fuel the fire for them. And usually it's been cheap, right, over the last few years. And so now all of a sudden, though, we're going to an environment where it's going to get more expensive, right? Especially if the Fed follows through their plan, quite a bit more expensive. I mean, how do, these companies raise money most of the time? It's through corporate bonds, right? Or they take on loans. But eventually they try to, refinance their debt. They're always taking on new debt, try to continue to fuel all that growth and stuff. And so, what have you seen happen out in the market, right? You got the Fed's going to be raising rates. What do you see with interest rates? They're all across the board. They're going up. What are you seeing with bond yields? They're skyrocketing, right? And I ran across this tweet right here from a guy named Dylan LeClaire, who I don't know or anything, but I can confirm I actually did look at every one of these separately. And you can see right here, I mean, corporate bonds, government bonds, whatever the bonds you want to name, have just been absolutely hammered down, right, across the globe. Look at the yields, just skyrocketing. I don't care if it's a 2-year, 10-year, 30-year, whatever, 3-month, they're skyrocketing. Then you see the NASDAQ over here is barely sold off, right? But then look at this. This is from Bloomberg recently. And the sell-off has been so bad percentage-wise, it's actually below what happened in 2008 during that crisis. In 2000 when Greenspan raised rates during and after the dot-com bubble. And the truth is, if you don't own high-growth stocks or tech stocks or companies that have to take on a lot of debt, you can just click all these videos. It shouldn't really matter to you, right? But if you own a company and you look at those balance sheets, and they do have to take on quite a bit of debt. They're going to have to refinance quite a bit of debt. Well, this is going to affect those stocks, which means your investment, which means it's going to affect their valuation, okay? And so, I'm going to let you listen to a guy who the good news is a lot of people out there are trying to scare people with credit spreads, widening and all this stuff like that. But he kind of puts that to bed and says, right now we don't have to worry about that. But, here's what's happening right now. Here's what he's seeing, and this is pretty much all he does every day.
Bond market itself has to function well, not only for end investors, but it really needs to function well for many of the corporations who've been relying on debt capital to fund their operations, especially during the pandemic. And we saw record borrowing in 2020 and 2021. We're still seeing borrowing and deals getting done in 2022. However, I think what everybody needs to pay attention to is whether or not the market itself starts to lock up, where you don't see a lot of buying and selling, and you're seeing the values of corporate bonds gap down. That would indicate that any of the companies out there that are highly levered, that have a bunch of bonds coming due within the next 18 months, are really going to struggle with refinancing at rates that are nowhere near what they've been used to.
And to show you what he's talking about this crazy amount of debt these companies have been taking on, this ended in September of 2021, this data here. So this number will be much higher by the end of 2021. I'm sure higher in 2018, higher in 2019. I don't think anything will beat 2020. But look at all the debt that was taken on in 2020. That is just crazy amounts. When you look at between 17 and 19, they're actually taking on less debt. But that is not the case now. They're taking on a lot of debt. And of course, the big question is, what do we need to be looking out for to show the bond market is not functioning properly? And there could be just come this huge wave for companies that just are having to refinance at much higher rates, are having to take on debt at much higher rates, are having trouble refinancing their debt. That's a whole nother thing we didn't even talk about, And so basically, when is the bond market, which is way bigger than the stock market, not functioning properly? And so he gives us two things, basically, which I would definitely be watching out for you guys if you're not looking yourself. So let's check it out.
So the two numbers to really look at to understand how healthy is a corporate bond market. One of them is a transaction data number that we have at BondClick called customer flow. It's looking at net customer buying versus net customer selling. And actually, since the attack of the Ukraine by Russia, we've actually seen it be flat in terms of buying and selling, which is pretty normal for conditions. Obviously, some sectors have been hit and bonds are being repriced lower. But I would be concerned if we were seeing net selling and bonds being repriced lower, because that would indicate that nobody is out here looking to buy bonds at these yields. And that's something that would be quite concerning and would look like March 2020 April 2020, when there were some material concerns about the structure of the market. That second indicator, and I just want to make sure we got to this, is you really have to look at what the dealers are doing in the corporate bond market. I think that the dealers and how active they are, and the bid offer spreads that they're offering in the marketplace. And I do believe I gave some data that we have over at BondClick regarding bid offer spreads. But you want to look at that because that's going to tell you how expensive it is to trade the corporate bond market. If bid offer spreads really widened out, then that's a really negative indicator in terms of what the future holds in terms of a well-functioning corporate bond market. And I say well-functioning because I think what we all can expect is that, yes, fixed income is going to be repriced. Corporate bonds are going to lose value because interest rates are going higher. And especially since the Fed now has to sell out of this $9 trillion position, which I think you could do an entire show on. But for now, are people able to trade? And the answer unequivocally is yes, you can trade in this market. And I think that's really important. Can you bring new bonds to this market? Yes, you have been able to do that. That being said, I would really pay attention to how conditions are going forward because opinions could change in this market and it might get really rocky. And the one difference today is that I don't think the Fed's going to step in and be the buyer of last resort like they were in 2020.
And that's the really big thing here, guys, is we're at a moment in time where we've never had a Fed have to offload such a huge balance sheet. Okay, it's never been anywhere close to this. And who's going to buy? I don't know. But it's kind of like, flooding the market, right? Like who's going to buy all of the mortgage-backed securities, the bonds, all that stuff, the treasuries? I mean, I don't know, right? And that's really the bigger thing because who wants to own that stuff right now? If obviously, as he said, when interest rates go up, usually bond prices go down, yields go up. And so they're already heading south, right? And then, of course, a lot of people think, well, the Fed will just step back in and they'll save the day. And maybe they do. Nobody can answer that. I mean, are they in the position to do that right now? Yeah, that's what's so crazy because, tomorrow we get the CPI data and my God, I say, it's going to be over 8%. We know it's going to be over 8%, estimated between 8.3, 8.5. And I mean, can you just imagine you're sitting at that kind of interest rate, that kind of inflation, and the Fed says we're done, we're not going to raise interest rates anymore, we're not going to roll off the balance sheet. I mean, can you just imagine that? That would be again, unprecedented. We're in unprecedented times, right? And so, yeah, for these companies, and this is, I own some of these companies where you look at it and you go, whew, got to start watching how much, what's the price they're getting this debt at, right? How are they able to refinance their debt? But more importantly, the bond market has to continue to function. That's really the key. It has to continue to function. And it's just like a bloodbath out there right now. But the reason why the stock market is not doing what they want to do is simple. It's, again, the only game in town. You hear people now, they're talking about how FANG stocks and Tesla are inflation hedges, right? That's another big thing. And nobody knows, but people are looking at each other going, well, is it? I don't know. Right? Because the reason why they're saying that is because the FANG stocks have so much cash on hand. I'm talking about billions of dollars of cash. It's crazy amounts of cash. It's insane how much they've actually put back all these years, and they're just so big that the institutions can't let them really go down because they're so weighted in all the ETFs, and it's mind-boggling. Don't forget, 10 stocks make up 30% of the S&P. 10. And by the way, it's not the S&P 500, just for a trivia thing for you if you ever want to know this. It's actually 505 stocks because there are multiple stocks on there that have different classes of shares like Berkshire, and I even think Google's both trade on there as well. So it's actually 505. So 10 stocks out of 505 on the S&P 505 make up 30% of it. In the NASDAQ, it's way worse, right? It's like 46, 47% or something like that. And so if you let just 6 to 10 stocks, a couple of handfuls of stocks go down, double digits, God forbid, that would let the market sell off. That's when it's going to happen. But until those stocks actually start to sell out, and you're starting to see that now, which today kind of spooked a lot of people, which had a lot of downgrades. NVIDIA's price target got cut, right? Somebody coming after Microsoft today, okay? And so you got Apple falling below a certain level, which people are kind of going, wait a minute, because it's been on a really big run. And so if those stocks, those like just 10 stocks, start to falter and head down, then the market goes down, right? Because you've already seen it. What's happening to high growth stocks? They've just been decimated. That's the one thing I would say. Yes, they can go down. Sure can. Maybe they go to zero, but at this point in time, when you're down 80, 90%, you can see the floor. It's right there, right? So if you're holding on to those stocks, you kind of go, oh, well, that's the good thing. I mean, you can't really go down much farther. The floor is right there when you were way up here, But those FANG stocks, those 10 stocks, yeah, they got a long way to fall if the market's going to fall. And so that's really what that's why you just see like everybody's like, I don't know, what are we doing? And I said it last year multiple times, I hate it that the institutions have allowed just a handful of stocks to basically decide the whole market. Like it's just staggering, because if those 10 stocks go down, they take everything else down with them, right? Because everybody starts to panic. And so anyway, that's where I'm at with it. Just want to put that out on your radar. Okay, put it on your radar. I know it's not something we normally talk about. I'm gonna be watching out for it. I'm gonna be a hawk on credit spreads, all this different stuff. I'm gonna be researching, trying to figure out, just to get a heads up on what's happening, to try to see it coming a mile ahead. That's what I'm trying to figure out here. If I can, we'll see. And anyway, if you're an expert on those two things, let me know in the comments. Hook up with you. Hopefully you got something out of it. Hit the like and subscribe button if you did. And I'll see you tomorrow after we get the dreaded CPI data out, and we'll see if this market's trying to head fake. We'll see if it's trying to say, let's sell off now, and then if we get 8.5, which I think is the projection they're putting out there, then we'll start rocketing it up, because we got 8.5, which is mind-boggling that's priced in. But who knows? All right, so I'll see you guys later. Have a good night.